It's my privilege and pleasure to kick off this 2023 webinar series, organized and coordinated by George. He's done a fabulous job lining up a great slate of speakers and managing the registration process. I have the opportunity and the privilege to introduce Steen Thomsen. I know he's known to a lot of you, but I'd like to read from his bio sketch some of the highlights. He's the Novo Nordisk Foundation Professor of Enterprise Foundations at the Center for Corporate Governance, which I believe, Steen, you were one of the founding members. He's at Copenhagen Business School, and he founded that center, yes, in 2005. He's made a lifelong study of corporate governance as a teacher, researcher, consultant, and commentator. He has more than 40 international journal articles and several books on that subject. His current focus is on enterprise foundations, and he is a founding board member of Board Meter, which produces software-based board evaluation, and is chairman of the Pluto Foundation, which works to protect global biodiversity. So his sustainability topic is near and dear to his heart, and he's been looking at this for a while. He's academic director of the Danish board, leading Danish business newspaper, which is Borsen. So he has some actual board experience, and he's contributed to best practice codes, public policy, and legislation in the area of corporate governance. Let me just say parenthetically that Steen is a unique colleague in that I see him pursuing excellence both in academia and in practice. And that's something that far too few academics pursue, and I deeply admire him for that dual focus. Finally, I just want to mention that Steen's a dear friend and colleague who helped to launch ICGS, which is hosting this, and he helped us with our first conference, and he guided us through our early growing pains. So without further ado, Steen, we're delighted to have you here. We're interested in your topic. Steen will be giving roughly a 30-minute talk, 30, 35, 40 minutes. And if you have questions, please post those questions in the chat area, and I will select from those questions. Normally, we don't get to all of them, but I'll do my best to get to as many of them as I can. And this session will be recorded, and it will be posted at the ICGS website. So Steen, delighted.
Yeah. Thank you very much, Bill, for that generous introduction coming from the master. So it's been such a pleasure, and really about ICGS, you did all of the work, and that's not even a secret, right? It's a public secret. So I'm very grateful to be here, and I really think this topic is interesting. And normally, you know, I do foundations, right, these days, but I just couldn't help it because the policy implications of this and the magnitude of the issues is just such that I had to write a paper. So actually, I'm going to share screen, and I'm going to start presenting something on enterprise foundations, but on sustainable corporate governance. Yeah. So I hope you can see, you know, and then I'll just, yeah. Is it working? What are you seeing now? Are you seeing it?
Display setting and then switch.
Yeah. Okay. Slideshow. Is it working now?
Yes. Yeah.
Good. Very nice. Very nice. Good. Very nice. Okay. So I'm actually writing a paper of this. I'm not quite ready to distribute it broadly, but you know, and one reason is that every day there's new research which I have to include. You know, so sometimes 4 papers a day, right, coming in on this topic. So basically, I'd like to start by setting the scene And as you know, right, we are in the middle of a transition to net zero. And then it has implications for business, for finance. In the EU, we have the Sustainable Finance Program. It has implications for reporting. There's actually a new reporting directive just being adopted in December by the European Union. We have directives coming on supply chain and supply chain due diligence. And now, big question is whether we need something on governance. And I want to impress, of course, that this, what we're talking about, this transition process, it's not a minor thing, right? If you look at all the macroeconomic calculations on this, what you see is that we're going to have investments of, it's not like billions, we're talking trillions now a year, right? And we're going to need them for a very long time, right? So maybe for 30 years, we're going to need to invest 4 to 6 trillion a year, right? You know, and that's because the global GDP is about 100 billion. So that's about 4 to 6, % of global GDP a year for 30 years, right? This is ridiculous. It's so much money we're talking about. So it's on the same scale as a war. If you think about it, I mean, the Second World War was more in terms of GDP, but basically this is more protected, right? So the idea of the climate war is actually not that, exaggerated. We have some, and so we're going to invest for a very long time, and at some point, we'll start to reap the benefit of that investment, and the investments will be, global growth rates are about, let's say, 4 to 6% of GDP a year, right? So you can, actually say that a lot of the growth that we will be having for the next many years will essentially be swallowed by the need to invest, to take purchasing power and put it into the transition process. And if you want to read my favorite book about this, it's Bill Gates's book, which was actually very clear on the order of magnitude of the problem. So I'm going to make some assumptions. I'd say that science shows that we have to get to net zero carbon emissions to stabilize the climate. So not just even a little bit, globally net zero is the aim. And so we're talking about this as a major challenge. If you think about the Corona crisis, that was maybe 2 years of lost output, maybe even not that, but this is 10 times larger, right? In terms of economic magnitude. And it's not just climate. There's a broader set of issues related to global poverty, biodiversity, you name it. And we're facing governments which will do too little too late, realistically. I mean, they make grand proclamations and so on at some of these meetings, but actually what we're seeing now is that businesses are making more proclamations than governments. They're not committing very much at the government level. So and so basically, I think it's more or less unavoidable that we'll not hit the targets that we've set up for this, and that we will see significant global warming, climate change, and business will be blamed, and so business will be caught up in this whether we like it or not. And so our role then is to see, what role can governance play in this. So I'll start by defining sustainability in the classical sense. Meeting the needs of the present without compromising the ability of the future generations to meet their own needs, and just indicate by the Sustainable Development Goals the kind of breadth of the problems. So we have to have all these equilibria. We can perhaps, if we save, and reduce GDP, we can also reduce carbon emissions, but it will, global poverty will suffer greatly, and so on. So actually, during the Corona crisis, what you saw was that biodiversity suffered in most of the world, and paradoxically, because the local developing country governments were short of funds simply to continue their biodiversity program. So this is really a difficult set of equations. We're talking about many trade-offs here. Okay, so where does corporate governance enter into the picture? I'm going to try to give you kind of a kind of bird's eye view of this as I see it, starting from regulation, which of course influences corporate governance, but also climate regulation in general, which is not directly corporate governance. And then, we have the different levels, if you will, of the corporate governance hierarchy, starting with ownership, boards, management, and so at each level we can see, ideas for and some practice for how to progress. So it seems, the reason why I say politicians will do too little too late is we know what happens if we take the first best instrument, which is probably a carbon tax in the climate question. Then we get the yellow vests, as we saw in France, and even a powerful figure like President Macron had to back out, right? And they're not going to try it again. So basically, many in the European Union are now searching for alternative avenues, second best solutions, of which corporate governance is one. So we had a long discussion about whether sustainable corporate governance could kind of be a substitute or at least a helpful mechanism to help repair or make up for the political failure. And I'm unfortunately I don't have time to because there's to take that discussion now. So I cut it out and focus now on what we call corporate governance proper. So I start with company purpose, which Colin Mayer says. Basically, if there's one thing owners own, it's not the company, it's the purpose. They own the purpose. So, and many, descriptions of, transitions to sustainability and so on, like Paul Pullman's description of what he did at Unilever, actually takes this view that you start by redefining the purpose of the company. So many companies are doing that. Basically trying to say how the company contributes to society. And, classical example that I've worked with is IKEA, which basically is a very economical group. The idea is to provide people with cheap, or at least affordable home furnishing products, so at prices so low that as many people will be able to afford them. So it's not so much about profits, it's about reach, if you will, for IKEA. And basically, you see many examples of this. I have a number of examples here, and the different purpose statements are different. You can have some of the more banal, brewing for a better day today and tomorrow, or enabling cost competitive and simple and sustainable global trade, or making sustainable living commonplace, and so on. There are many of these. Actually, we were trying to do some work on categorizing corporate purpose statements, and we find that of the largest European companies, we have about 40% which already have purpose statements, and the rest, most of the rest, have similar statements. They just call it vision, mission, and so on. And if we categorize, we see most of the statements are related to customers. Some are related to the product and a bit more, about what the product does. Some are related downright to sustainability, and some are related to product and so on. So some are just slogans, something which sounds nice, which had very little meaning, and like being number one, for example, you could also regard that as a slogan, and so very few have nothing at all. So that's where we are, and basically what we're seeing is an evolution of company purposes, which in the first statement is very often, we are a shipping company. It's about the product or the service which is being offered. And the second question is, generation is, the reason why we do shipping is because it benefits something, maybe world trade or our customers and so on. And then, there's a broader discussion. We create value for our customers, but we also want to make sure that we create value for our stakeholders in general. And then basically you get into this purpose statement where we want to create value for society, to our businesses, and ensuring a net positive contribution to all stakeholders. If you want to read a really good book about this, I highly recommend Paul Pullman's book with Andrew Winston called Net Positive, where he actually goes in detail, not just with the concept, where he started with purpose, but also with the practice of it, because he had many dilemmas on the way, as you can imagine, in a big conglomerate as Unilever. So basically, they end up with something which is very, very similar to what in economics terms we would call value creation net of social costs, also not just of private costs, but net of social costs, basically internalizing externalities, which is, by the way, also Colin Mayer's idea of what purpose should be. Any purpose is admissible, he says, as long as this criterion is fulfilled. But that's not an easy criterion to fulfill. But that's what we have. So basically, how much can we do with purpose? I mean, just writing it down is, it will not change anything just to write a purpose down, So basically, it all lies in the commitment. So how much commitment can we give it? And that's related to the governance structure, I think. So what if you delve into this, you very quickly discover that purpose is, I think it can be important. And I see many examples, I think, of companies which are trying to do the right thing, but a meaningful purpose must be rooted and very, very rooted, if you will, in the ownership, because if the owners don't agree, then it's not going to work. And of course, the board and the management must really sign on to this in a deep way. So that means that when we talk about purpose, we kind of pass the buck. We have to look at owners. What about owners? What owners are likely to sign on to sustainability? So I progress to ownership. And I start by classifying different owners in terms of their time horizons. So some owners, you can say, have very short time horizons. Some financial investors, like some asset managers and some mom and pop private investors, and of course high frequency traders and hedge funds and so on, generally have very short time horizons. And then you have some types of owners which have very long horizons. Many founders are not thinking about exiting, families, foundations, co-ops and mutuals and so on. And in between, you have strategic shareholders like private equity and institutional investors who both, incidentally, hold their stock on average for 5 years. And so these guys over here, the financial investors and the strategic shareholders, are generally agents, which means that it's very difficult for them to deviate from creating value, also financial value for their clients. These guys over here, the founders, the families, the foundations, and the co-ops, they actually have the possibility to have another objective than just creating shareholder value, if you will, because they're not accountable in that sense to anybody except maybe God, and maybe they get these religious thoughts. So we talk about stewardship over here, and we talk maybe about agency over there. And a prime example of that is, of course, Shunar, who just transited Patagonia, which is, those of you who don't use that product, you should use them, because it's basically the best trekking clothes that you can get. And they've been having this very sustainable profile for a long time. And finally, the founder decided he would give the entire company, and his descendants agreed, his children agreed to a foundation, and the goal of the foundation would be to run Patagonia in a sustainable way, and any dividends would go to climate purposes. So that was a major victory. He showed that this foundation idea could actually be practiced in the US also. So that's a major gain for the whole movement, if you will. So basically, is it the case that foundations are generally more, sustainable? Yes, we can show that. I have a paper with David Schroeder about this, that the foundation-owned companies this is just the descriptive stats, but we can back it up by different econometric tests and so on. Basically, they do better than both family firms and investor-owned firms. So foundations, the big problem here is we can't ask the whole world to transition to sustainability, or we can ask them to transition to sustainability, but we can't ask them to transition to foundation ownership. It will be also in the future a very few who are able to make this supreme sacrifice of giving away billions of dollars, right, to a foundation, and it's not your money anymore, and you can't use it to buy fancy cars or whatever. So basically, so we have to ask the question: what about the other owners? And actually, Nikos and I did a paper which has been published last year on this, where we try to survey the relationship between sustainability and corporate governance, and more precisely, the relationship between corporate ownership and sustainability. The key, table here was where we surveyed the number of articles, and we kind of which ones found positive effects, which ones found negative effects, and which ones found non-significant effects, and so on. So basically, this works for institutional investors. They generally, have a positive effect. The state-owned enterprises generally have a positive effect, and foreign multinationals generally are associated with better sustainability outcomes. But it doesn't work very well for family businesses. which we all believe in other contexts to be a very long-term ownership structure. So we kind of had to invent the secret sauce here, which we call stewardship. That basically we want, what happens in family businesses is not just a function of the ownership structure, but of the way that the families conceive of or perceive their objective. And so they do have the incentive because they want to be around for the next 50 years, many of them more 100 years. But whether they actually do so turns out to be a matter of software rather than hardware, as a metaphor. So okay, yeah. Then next point is we see that many investors now, pension funds and so on, are becoming active in ESG. We reckon that maybe in a few years it'll be a fifth of all investments which will be ESG related. And in the US, some people say it's already 1/3 of invested assets already now, right? So we're talking about a lot of capital being flowing into sustainable investments. And of course, we have to think about what is happening here. Why is this actually happening? Because it's a bit of a paradox if we have these pension funds, which we usually regard as maximizing shareholder value and even having a fiduciary duty to do it. Why is this happening? So actually, this is where Oliver Hart and Luigi Sindegales come into the picture, trying to create kind of a rationale for this, which they call the new corporate governance. And the key idea which they have is that, well, there is a contradiction between shareholder value and in the common good, social value, if you will, when there are externalities. But universal owners like BlackRock, which have a very diversified global portfolio in that sense, they own the world more or less. And also because they have a very diversified client base, they actually are in some sense owned by the world. And these guys will rationally take externalities into account, even when they approach individual businesses, because they're interested in the portfolio, which internalizes many of these externalities. So in their viewpoint, shareholder value needs to be replaced by shareholder welfare, as a decision criteria, which is broader, of course, looking at the portfolio. And so basically, I think this idea has been around for some time, but they kind of put the theoretical argument. So is this in fact what's happening? And so basically, just to nail one part of it is the big three asset managers, they are not owned by the world. They actually own each other, right? So Vanguard is a partnership which is not owned by anybody, but Vanguard and BlackRock collectively own 43% of State Street, and State Street and Vanguard collectively owned to the different funds, and also directly owned about 32% of BlackRock. So basically, these guys are not held to account through the ownership, at least, So I'll get back to whether what is their real objective function here. And to do that, I think we have to look at the history of ESG ratings. So ESG actually was invented more or less by a working group under the Secretary General of the United Nations, Kofi Annan, at a time, and they issued a report in 2004 in which they actually launched the idea of ESG, and we've seen further developments on this. I'm not going to go into the details here because of time and so on, but basically, so who created ESG? So basically, ESG was created by the world's asset managers, and so basically, so why are these guys suddenly, filled with a need to do good for the world? Don't they have a private objective and so on? Well, it turns out basically that the fees on ESG investments are higher, right? So basically, these guys have a clear vested interest in launching these things. And I don't know if you remember the BRIC countries. I was very much against the concept, launched by Goldman Sachs, by the way, for a time, and used as an investment vehicle. So they had all these BRIC funds, right? And then, they got out, of course, before the investors saw the pain, right? So Goldman Sachs, in a way, if you just focus on one of them, I guess, is actually was very much behind the brick story, which wasn't that meaningful, and they're also behind this. But now, of course, many people trust ESG, right? And we can't say that Goldman Sachs are not honorable or anything like that. You just say that there's a little bit of an afterthought here in whether ESG. So let's try and look at the ESG research here. And so, I mean, there's a ton of papers now out, and all of them kind of show big problems with ESG. Lager at Stanford or George Serafeim is talking about hyperboles, at least in some of it, and aggregate confusion because the ESG ratings do not agree. And there's a paper which shows that they retrofit every month. They retrofit the ESG ratings to make them seen as if they're correlated with shareholder value creation in these companies. So there's so much manipulation going on here. There's even a paper which says that if you invest in high ESG ratings, basically you invest in high carbon, not low carbon, right? And they show this in this paper. So I and a colleague actually tried to do this. So let me just show you later on, just saying some of the problems here. I already went through them. So basically, and even to the point where SEC chair Jay Clayton warned against this, right? There's a lot of risk to these concepts. But let me just take this idea of carbon, seriously. So here we are looking at ESG ratings, and we try to examine whether ESG ratings are associated with low or high carbon emissions, and we have carbon emissions intensity, % of sales, and so on. So we actually, in this paper, it's my and my colleagues, figures here, but we're trying to replicate the previous finding that I talked about. So basically, what you see that high ESG ratings are associated with higher ESG ratings, not lower ESG ratings. So this is a rebalanced portfolio. If you just have a buy and hold portfolio, you see the same. Even, so if you bought high ESG in 2005, you actually have, first of all, you have higher carbon emissions, but you also have less reductions in the carbon emissions. So they flatten out here, this group of companies. So if we invest in ESG, this investment is and basically we're not getting I would say the core objective, I think, in ESG, as far as I see it, is the climate stuff. And so basically, so this is a problem, right? Money is flowing into something which may not actually be doing what it's intended to do. Okay, so a second thing is, that if we look at sustainability, owners not just have screening where they try to invest in high ESG. They also sometimes are active, and there's actually some literature about that. More and more funds behave as engine number one, which tries to challenge Exxon and so on. And the literature done by Serafeim actually says very clearly that these things are value increasing, but they're value increasing if the ESG issue is material for the company. Like in an oil company, that's different. You have different carbon profile than you have in a bank, at least the scope 1 emissions and so on. So basically, or in a pharma company, carbon emissions are not that. Maybe there are other material issues in a pharma company and so on. So basically, that's Serafeim's conclusions here, that materiality is very important. But if materiality is very important, this essentially means that that firm-specific issues are very important, because what's material depends very much on the individual company. So the idea of regarding ESG as a compass which we can invest or measure our performance or anything like that is just looks like wrong, actually, basically. So ESG was invented by the asset management industry, and it's profitable for asset managers. ESG ratings are deeply flawed. We can show that in paper after paper, but of course widely used. And a couple of things to do about it would be, it's very important to focus on materiality here. So what's material for the individual company, not just the rating of all sorts of indicators, but what's most important for us. And secondly, there's a difference between the ratings and the verifiable variables like carbon emissions. It's some information which is invariably produced by the company, or work injuries invariably produced by the company, and so on. Work-life status invariably produced by the company, and more or less verifiable. But the ratings produced by the rating agencies here, not, right? So and their methodologies here are super unclear. And that's one reason why people are even the Securities and Exchange Commissions are worried about this. So basically, Bill, I have many slides, but let me just talk a little bit about boards then. So basically, what you see is that boards are increasingly adopting to sustainability, and one way they're adopting them is to have sustainability committees. So we find that a lot of the big US companies now have sustainability committees. It's not that common in Europe and so on. But if you examine the competences which are involved here in the sustainability and in general in the American companies, this Fortune 100 sample, what you see is that there's a severe lack of competences in the E area, in the environmental area. Only 6% of boards, and I think that's maybe an exaggeration, that they have E competences, but S competence we have okay covered, and G competence people say no, but I'm comfortable with that. But I'm really worried about this E competence because they have to make these massive investments, in alternative energy sources and so on, and not knowing what they're talking about. Finally, there's a literature about gender, of course, and sustainability, and some quite good tests which basically indicate that women are more likely to pay attention to, maybe even causally to pay attention to sustainability. So incentives, then that's the last slide I'll show. I have a number of other slides, but if you look at ESG incentives, we see that there's really fast growth in this is the ISS number of companies rated by ISS is roughly 10,000, so it's a lot of companies, and we see really fast growth in the adoption of ESG incentives for managers. And we also have some literature which indicates that this is associated with improvements in ESG performance. But we're not so sure about what's happening to the financial performance and so on. But what we also see is that these are the figures for the ESG metrics, where you see that actually, yes, it is increasing from 0 essentially up to 38% in this sample. So this is actually exploding more or less. But if we examine how much does it matter, and here is a case study of all majors in 1819, maybe a bit, too old now, but basically what we see is that the climate incentives account for 10%, something like that, on a good day, because not many have ESG incentives. They have it in their short run, incentives, but the long run incentives don't have it. So basically, I think what we're seeing is that we have, that yes, ESG incentives are spreading, but they're not that, important as a part of the total pay package. And of course, to have impact, they should be meaningful, and we need to see, much higher percentages here. So I have slides on management also and so on, but climate plans and climate risk management and internal carbon pricing and so on. But I think what I'll do is I'll stop sharing, because I do want to hear your opinion about the first part of the talk.
Thank you, Steen. As usual, very holistic and broad sweep. Let me remind everyone that if you have a statement, reaction to Steen's comments, or if you have a question, please put that in the chat function. And I will read that question to Steen, and perhaps Steen could respond. As an aside, one of the participants, Steen, asked, will the slides be available after this talk?
Yes.
That, of course, is your call.
No, they will be available.
Okay,
I think
we
it's
will
really,
make that available on the ICGS website after this talk. And of course, George is recording this session so that if you want to go back and review it, or if you're telling a colleague about this session, it will be freely available. So let me just throw out some questions or comments that are in chat, and I encourage others to formulate their statements and questions as well. One of the participants named Mark said, we actually need to go well beyond net zero to stabilize the climate. Net zero is not good enough anymore. It needs to be regenerative. Do you have a comment about
no,
that?
that's right, because we are not seeing many developing countries transitioning far enough, So we are going to have to go net positive. I think that's clear,
Okay.
So yeah.
Second question is by Franziska, says, I don't understand why investment funds can charge more for ESG. The assumption is that ESG reduces risk. So logically, the fees should be less. Can you explain?
Yeah, no, it's because it requires more, more work, to sort it out, right? I mean, I don't know. I'm not saying this is reasonable. I'm just saying that they are higher priced ESG funds. The fee is just higher, right? So, and what we see in normal fund management is because of the exchange traded funds and the indexing and so on, that the fees are being competed down to zero, actually, more or less, right? Very close to zero. So it's very difficult if you're Goldman Sachs to make a business in exchange traded funds. It's impossible, right? So their business has to move on, and so we need specialty products, where you kind of have a niche, and have a unique product and so on. It's kind of difficult in normal asset management these days. So that's the story, actually,
Okay. Marguerite has made a statement, ESG metrics such as those by MSCI, et cetera, are based on how much harm ESG can have on the firm's financial performance. Yet these are the ones being used to identify whether a particular investment is green or not. How can we move beyond this arrangement?
Yeah, we're talking about single and double materiality here. So double materiality, if you include both the impact on the firm, what can climate do for the firm, but also how much damage can the firm do for the climate, right? And so this is a very alive discussion here, I think. And I think that some of the ratings actually try to when in rate actually to pick up these effects. Yeah.
So just to pursue that, if the ratings agencies invested in independent boards or some sort of mechanism to track the actual impact on the natural environment, this will let us see what the actual impact is beyond just the firm. Is that what you're saying?
So basically, I think we are seeing now double materiality as a standard, emerging, so I think this is a very live discussion. I mean, I know that many ratings so far have been concerned mainly with financial value creation, but I think we're moving quite quickly beyond that. So it's a really valid point and so on. But I think as I get the drift of the discussion, we are moving in that direction. But as you can sense, that's not so much my concern, right? My concern is that these measures are so bad as they are, right? And they're not really capturing what we think they should be capturing. And there's very great subjectivity here. And I know from ISS that I know, basically the way they do their ratings, they actually ask the students, student assistants and so on to do the ratings, and that's not good enough, right? It's like, I had one intern who was at ISS during the summer vacation, and he had rated so many companies, right? He was so proud of himself, yeah. And I'm really afraid of that level, right? So you should be aware that these are very, very for-profit companies. They're not part of the government, right? Yeah.
So this next question, I'm going to modify it a little bit. Niels asked, to what extent do ESG incentives as an instrument make companies more sustainable? My assumption is not very much, because ESG is not really reliable. But let me build upon that. In your mind, if we use a more accurate, comprehensive, valid, and reliable measure
Yes.
of ESG, then we hook incentives to it, then you'll see major changes.
I think so. And the Economist in their June article on ESG, the end of ESG, something like that, right? They actually imagine the situation where we forget about the S and the G, focus on E, and within E, focus on carbon. That was their solution because of the sheer complexity of having all these different goals. We know what happens if you have many goals and so on. So that's one strand. Basically we need to be very clear, and when you have these very clear incentives, you'll get the results. But you run into the famous incentive problem. If you incentivize people for one thing, they'll do that thing and they'll forget, about the whole, so to say. And I think this is so what incentive theorists like Milgram and Roberts recommend here is, if you have very complex problems, you don't use incentives, right? Basically you go to fixed pay more or less, and you try to use other mechanisms to make management work as you would like. Yeah.
So William agrees with you that political actors cannot and will not act because they'll be held account, they'll be voted out of office, basically, if they do the responsible thing. But William also despairs that the only reason why business will act is if the public governance forces them to. How do you see a way around that? For instance, can you imagine business doing the right thing absent of political pressure?
Yeah, I think they are doing the right thing, and they are trying to move, in many ways. But they're also trying to do a lot of greenwashing, to be on the right side of history all the time, and to do things which have symbolic significance. And banks making, having targets not for themselves, no, for their customers, right? So we will reduce carbon emissions among our customers, right? Stuff like that. They can make all sorts of statements which just, they're not in charge of what their customers do, right? Yeah. So basically, we see a lot of, there's so much noise here, and so back to the way I try to advertise the seminar, I was saying, we're trying to do too much too fast. I would say, let's just try and stand back a little bit and think about what are we doing, and then maybe if we do something smart, maybe we'll have an effect. Because right now, as the way it looks to me, we're not having much of an effect, because we're kind of trying to press all the buttons at the same time, and the whole machine is likely to jam, I think. Yeah.
Let me ask a question related to that. Are you aware of any serious ESG measurement efforts? I think we'd all agree, and the research shows the existing and previous ones have kind of been a sham. But everyone more and more is seeing the emperor has no clothes. Are you aware of any agency, country, governance mechanism that's seriously measuring corporations' impact on the environment?
No, I don't want to talk about, because there are different opinions about what's right and wrong here. But I think what most of them produce substantive information, right? Like carbon, or work injuries and so on. And you can pick out that information, and this is meaningful information. So what's not meaningful, I think, in most cases, are the ratings, the values which they give to this, and the overall ratings where they bunch, E, S, and G in one measure, right? We know it's crap, right? Basically, and so, but now we have it. I mean, when I try to lecture on this, it's as if I'm trying to lecture against the good, right? ESG is good, right? So basically, and so we've come quite far on this, and I think our role as scholars is to try to, help people, make the right decisions and to focus on the right issues. And we do have a role here, and saying that, oh, we need to rush because we have this sense of urgency is not very helpful, right? Because I think it's really important that we do the right, and this will anyhow be a marathon. It will take 30 years, So we have time. We have time to think. Don't worry. It's good that we can start, and so we just know that probably ESG is not the right place to start, if I'm right, but we also know that it's not just climate, right? So it would be easy if we just so probably what we need to have a set of indicators, right, which we believe are kind of more or less meaningful, right, and especially work a lot with individual companies which have individual, what is material for the individual companies differs. So, and if we take that seriously, maybe ESG is gone, right? Because their business model is that you can produce measures which are valid for all companies, right? Yeah. And really they're not valid, right? So, but the information which they collect, which is produced by the companies, by the way, is very often meaningful, and so let's try to work a little bit more on that.
So Ruth has a comment, said, you did not mention employees and global value chains, basically pointing out there is a level, quote unquote, in the organizational hierarchy below management, and that's the employees that can affect this. And also there are value chains, things outside of the boundary of the firm that can affect the sustainability, whatnot. What's your opinion on what leverage employees have and leverage we can have on value chains?
Yeah, so basically we can have a lot of influence on value chains, and I think you're aware, Ruth, that there is this corporate sustainability directive, supply chain due diligence directive, right, which basically asks companies in some of the drafts which are being circulated, individual board members of large multinationals will be responsible for the entire value chain, for climate, and for human rights and so on in the entire value chain. And this is one of the things I had to cut out of my presentation here. But I'm really afraid that if you do that, because they have really no way of assessing these, knowing what issues will turn up and so on, it'll just lead to massive, risk aversion. And and so basically pulling out of developing countries and so on, which would be, I think, completely non-productive. We know, for example, that from the studies that I did with Nikos, that multinational companies, subsidiaries, actually do better in terms of sustainability than the local companies in most cases, right? So, but also even the economic impact here, if they all withdraw, let's say from very poor countries, it's a disaster, right? And there'll be little money for biodiversity and whatever, and you can forget about climate, of course. Yeah.
I'm going to insert a question of my own. You recall down in Miami, we had an excellent presentation at our annual conference from a gentleman who commented on BlackRock, and Larry Fink came out and said, dirty companies are more risk, and we're going to reflect that in our investment futures. And it was revolutionary. They managed over $1 trillion. And what was the outcome? The money flowed to BlackRock's competitors, and BlackRock backed off. So how do we get around this? Clearly, the active investment community, Larry's statement, I think he sincerely believed it, but he got burned by it. He got his wrist slapped, and we reverted. The market rewarded those who said, "No, we'll take your money, your carbon-tainted money."
Yeah, so that's a real issue, of course. So I'm kind of looking at green bonds, right? And the yield on green bonds, right? It's very low, right? It's about 1%, or something like that. At least it was before the interest rates started to rise. So it's really low, right? And so I was saying to these pension funds people that I know, how can you do this? You have pensionists, right? They say, yeah, of course, the risk is lower, but is it really lower? Is it really? I mean, I'm not sure about that. It's more like it's a way to argue by definitions, right? It must be lower because finance theory tells us that it is lower, right? But it's not always the case that if you have low yields that you have lower risk, right? This is in an equilibrium which requires a lot of market activity to be reached and so on. So I'm not sure we're there with green bonds. I think what we're seeing with green bonds, we're seeing a preference, basically. So some investors are desperate to be in green bonds, and they're actually paying the price. just like there's a literature about sin stocks, right? They generally are very good for, for high dividends and so on, right? And so because respectable investors won't touch them, right? So some private investors have a ball, investing in sin stocks, right? And in the same, this is a reverse sin stock phenomenon, So there is a trade-off between preferences here and financial value creation. I think, and I agree with you that in the long term it might not last. If I guess if I got a letter from my pension fund saying, well, you'll actually get a reduced pension because we were, whatever, I'm not sure, that I would necessarily, accept that, if it was a small amount, okay, but if it's a serious amount, no way.
Pasquale asked a very practical question in that if you were advising a board today, what would your advice be to them for the corporation to be serious about environmental sustainability?
I think we want board members who are more competent in E, right? I think, and this requires a different background, not the economists and the lawyers, and more engineers and more chemical engineers and more maybe natural scientists and so on, and definitely much more communication with these guys, because climate science, as it turns out, it's not really like a table, like a tide water table where you can see, okay, this is how it's going to go, and that's not how it works, right? It's it's because we have these dynamic feedback systems and so on. It's actually chaotic, right? We know this. Some meteorological phenomena are really strange, and so making predictions here is so that even the International Panel on Climate Change, they're not making predictions, right? They're only making scenarios, right? So basically taking that kind of information and interpreting and kind of working with it in a sensible way, it requires that you know something about it. And even knowing, that you don't, get to ridiculous, things which are not really important, immaterial stuff, right? And spend a lot of time on that and market it, that's not very productive. I don't think it's going to matter a lot for the company long term. It could be expensive, and it could also be that it's, companies will get caught on the wrong foot on this, and be accused of, greenwashing, or there's even a word for diversity washing now, right? There's so much washing going on, right?
Mm-hmm. Love the comprehensiveness of this discussion, Steen, and thanks for your direct responses. Pauline asks, can you give some examples of other mechanisms other than incentives that will play a role in us becoming more sustainable in the future? I mean, in the interest of time, you shorten your presentation, you talked about incentives, but can you speak a little bit to other governance mechanisms that could play a role in digging ourselves out of this hole?
But I do think that some owners, and I think this table showed you that some owners are just, family business is an exception, but most of the others, like, long-term pension funds, for example, are generally more active with sustainability. And I think it makes total sense, and the multinationals are more active, and so on. And the state-owned enterprises are more active. So basically that's a mechanism which generally will produce more sustainability. And if you look at boards, I think a sustainability committee, there is some literature which indicates that if you have a sustainability committee, you actually do more. So you can discuss causality here, right? But generally, it's maybe just a way to, to indicate that you want to do more in the future and so on. But I think it's possible also to signal that kind of, and I love if you have some more competences here, because then not just more is not necessarily better, right? It's like, better is better, right? So intelligent sustainability is, and we're all kind of, I think, caught in this bubble, that we want to be on the right side of history. We don't know where that is, but we are, constantly, we're really panicking that we're not there, right? Yeah.
Here we have an interesting question from someone at your center. Should we have a few ESG rating companies, like we have credit rating agencies, Moody's, Standard & Poor's, whatnot? Should we have an ESG sanctioned rating agency. Do you think there's any merit to that idea?
Rating the raters, yeah, that's really corporate governance, right? If I interpret that correctly, I think what needs to happen is that we should have mandatory, as we have in the European Union now, just adopted mandatory sustainability reporting, and they agree on. And I think basically it looks to me as if they're overdoing it. So basically, it's probably going to double audit costs, which are already now about 0.25% of global GDP, and it's going to rise to 0.5%, right? Which is, which about 5% of the total effort that we'll need every year, in sustainability or climate, right? So basically, it's too much already, I think, but I think it should be possible if we're a little intelligent to focus on the most meaningful numbers, and asking companies to produce these numbers. And this will basically, when this information is generally available, it will make the work of the rating agencies very, easy, and it will lower the fees that they can charge, and it will also, and I also think that the SEC and other equivalent institutions should ask to have their methodology published. Sorry, we need to know why they give the weight to X, and investors have, who use this for investment, right? In billions and billions, they have a legitimate claim to know what's going on when they're investing in this concept, right? And so I think that should be mandatory also.
So it sounds like a cross-disciplinary team of governance scholars who are experts in data collection and analysis and reliable and valid measures, working in conjunction with people who really understand impact on the environment. That could be a huge academic contribution to have
ICGS should do it, I think.
Yeah.
And you could lead the task force, Bill.
Okay. Our time is up. Thank you, everyone. Thank you especially to Steen for the stimulating talk. We're off to a great start. We will be having monthly meetings. We've got a meeting, a great webinar coming up in March. Watch your inbox for notices about that. Steen, thank you for your talk. George, thank you for coordinating and organizing all this.
And thank you for the opportunity. I would say it's really been a pleasure, to have this discussed. And I hope now that you are kind of persuaded, Bill, that it wasn't as idiotic as you thought, right?
Definitely given me a lot to consider. Thank you, everyone. Have a wonderful day.
Thank you.
Thank you, everyone. And thanks, Bill, for moderating.